Imagine opening your mailbox and finding a letter from the IRS. It says your home care agency has been selected for an audit. Your first thought might be, what did I do wrong? Maybe you claimed too many deductions. Maybe your business made too much money. Maybe something on your tax return looks suspicious. But here's something many business owners don't realize. Being selected for an IRS audit does not automatically mean you did something wrong. The IRS itself says that. So how does a tax return get selected? And if your home care agency is audited, what is the IRS actually looking for? That's what we're talking about today, because your goal shouldn't be to run your business afraid of an audit. Your goal should be to run your business so you're prepared if the IRS ever asks you to support what's on your tax return. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. And today, we are starting a brand new series for home care agency owners about IRS compliance, audits, and tax mistakes that can become very expensive when they're not handled correctly. So let's start with the basics. What exactly is an IRS audit? An IRS audit is an examination of your tax return and supporting information to determine whether what was reported is correct. The IRS may want to verify your income. It may want to verify your expenses. It may want documentation supporting deductions or credits. Or the examination may focus on one issue. But an audit does not necessarily mean the IRS is saying, we think you cheated. According to the IRS, being selected for an audit does not always suggest there is a problem. So how does your return get selected? There are several ways. One is computerized screening. The IRS can compare tax returns against statistical information from similar returns. The IRS also receives information about taxpayers from third parties through documents such as W-2s and 1099s. If information reported on the IRS doesn't match what's reported on your return, that can create questions. And sometimes a return may be selected because of a connection to another taxpayer whose return is being examined. For example, there may be a business relationship or transaction connecting the two tax returns. So I want you to move away from the idea that taking one particular deduction means you're automatically getting audited. That's not how I want you thinking about tax compliance. There are certainly reporting issues and circumstances that can create IRS scrutiny, and we're going to talk about 7 of those in the next video. But today, I want you to understand the bigger picture. Let's bring this specifically into a home care agency. Imagine Jane owns a home care agency. Agency reports $750,000 of revenue for the year. She has caregivers working for the agency, so payroll is one of her largest expenses. When Jane's tax return is filed, that return contains numbers: revenue, wages, payroll taxes, rent, insurance, software, professional fees, and other business expenses. But those numbers didn't simply appear on the tax return. There should be records behind them. Let's say Jane's return is selected for examination, and the IRS is looking at the income reported by the agency. Jane may need records supporting that income. If the IRS is examining a particular deduction, Jane may need documentation showing what she paid and why that expense qualifies as a business expense. The IRS says during an audit, it may request documents supporting income, credits, and deductions claimed on the return. And generally, these should be records already used to prepare your return, not something you're suddenly creating because you've been selected selected for an audit. And this brings us to something I really want you to remember. A number on your tax return has a story behind it. The tax return shows the number. Your records help explain how you got there. That's why audit readiness doesn't begin when the IRS letter arrives. It begins with how you're running your business today. Now, let's take another example. Imagine Jane has 10 caregivers and she's treating all 10 as independent contractors and issuing them Forms 1099. Does issuing a 1099 automatically make those caregivers independent contractors? No. If worker classification becomes an issue, the IRS looks at the actual relationship between the business and the worker. The IRS generally looks at the evidence within three broad categories: behavioral control, financial control, and the type of relationship between the parties. For example, does the agency have the right to direct and control how the caregiver performs the work? Who controls the financial and business aspects of the caregiver's work? And what does the actual relationship between the agency and the caregiver look like? The IRS says there isn't one factor or magic number of factors that automatically make someone an employee or an independent contractor. You have to look at the entire relationship, and even having a contract that calls someone an independent contractor doesn't automatically settle the question. The substance of the relationship matters. Why is this important? Because if a worker who should have been treated as an employee was improperly classified as an independent contractor, the business may potentially become responsible for employment taxes associated with that worker. Now, I'm not saying every caregiver is automatically an employee, and I'm not saying worker classification is what every IRS audit of a home care agency will examine. I'm using this example to show you what an examination can actually mean. The IRS isn't necessarily just looking at a number and asking, does this number look too high? It may be examining the facts behind that number. And here's something else I found interesting while researching this video. The IRS publishes what are called Audit Technique Guides. These guides are primarily written to help IRS examiners understand particular industries and tax issues. They can cover industry practices, accounting methods, common tax issues, examination techniques, interview techniques, and how evidence may be evaluated. Now, as of this recording, the IRS does not list an audit technique guide specifically for home care agencies. But that's not really the important part. The important part is understanding how an examination works. Depending on what's being examined, IRS examiners may have established resources and examination techniques to help them evaluate the issue. And that brings us to what I think is the most important lesson in today's video. Your goal should not be to make your tax return look less suspicious. Your goal should be to file an accurate tax return and have the records to support it. Those are two completely different mindsets. I don't want you avoiding a legitimate tax deduction because someone online told you don't take that deduction because it will trigger an audit. If you're legally entitled to a deduction, you shouldn't be afraid of taking it simply because somebody called it a red flag. But you should understand the rules. Keep the appropriate documentation and make sure what's reported on your return reflects what actually happened in your business. That's tax compliance. And that's what I want this entire series to help you understand. So what actually happens if you're selected for an audit? The IRS says it will initially contact you by mail. It doesn't initiate an audit by calling you on the telephone. Audits can also happen in different ways. Some are conducted by mail. Others may involve an in-person interview and review of records. And here is another important distinction. Not every IRS letter means you're being audited. We're going to talk later in this series about IRS notices, what they mean, and what you should do when you receive one. But there's one more question business owners often ask. How far back can the IRS audit you? Generally, the IRS says audits include returns filed within the last 3 years. If a substantial error is identified, additional years may be added. Although the IRS says it generally doesn't go back more than 6 years, there are exceptions to those general rules. So here is what's important for your business. Don't file your tax return and immediately assume you no longer need the records behind it. We're going to have an entire video in this series about what records your home care agency should keep and how long you should keep them. So let's bring everything together. Could your home care agency get audited? Yes. Any tax return can potentially be selected for examination, but being selected doesn't automatically mean you did something wrong. And your goal shouldn't be to spend your time trying to make your tax return look less auditable. Your goal is much more practical. Report your income accurately, handle your payroll and employment taxes correctly, maintain good financial records. Keep the documentation supporting what's reported on your return. And if the IRS ever asks you to explain a number, you want to be able to tell the story behind that number. Because audit readiness isn't something you start after the IRS letter arrives. It starts with how you run your business today. In the next video, we're going to talk about 7 tax red flags home care agency owners should avoid. And we're going to separate legitimate tax compliance concerns from some of the fear-based IRS audit trigger advice you may have heard online. If you're a home care agency owner and you need help with your business taxes or accounting, you'll find my information in the description below. And make sure you subscribe so you don't miss the rest of this series. I'll see you in the next video.